You can experiment with your investments. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like healthcare. With liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Welcome to another episode of Marketplace Minute. I'm DeLegge with ETFguide. The financial services industry likes to use boilerplate risk questionnaires to determine how people should be investing their money. I like to look at a person's investment portfolio because it succinctly tells me almost everything I need to know about a person's investments by how they're currently investing, not how they would like to invest or how they will invest. So my latest portfolio report card is for Mary. She's from Santee, California. We're going to look at her $353,000 401k plan, and I'm going to grade her portfolio on today's episode. I'm going to give her an A, a B, a C, a D, or an F. And remember, if she gets an A, that's a great score, and it also means I pay her $100. That, by the way, is a challenge that I send to all of our viewers. If your portfolio takes DeLegge's portfolio report card and gets an A, I pay you $100. So let me just give you a quick background about who Mary is and what type of investor she is. First of all, she's saving $17,500 annually in her 401k plan. Her company contributes another $3,500 of matches, and she told me that retiring at age 57 would make her very happy, but she's also okay with age 60. Now, she's in her mid-40s. She manages this 401k plan by herself without the help of an advisor, and she has her money currently invested across 7 mutual funds as well as company stock. So let's look at the first area that I grade all portfolios on, and that's diversification. Now, investment portfolios that lack exposure to the major asset classes clearly aren't diversified. And in Mary's case, her 401k plan has exposure to most of the biggies, including domestic and international stocks, along with bonds. Still, her retirement plan misses exposure to other major asset classes like commodities and real estate and cash. In terms of risk, let me just say this. Most investors don't realize they've taken too much risk with their money or exceeded their level of risk tolerance until it's far too late. And usually they learn that when the stock market takes a good old-fashioned clobbering. Now, her asset mix currently is 89% stocks, 6% in bonds, and 5% in company stock. Mary's current allocation, according to my risk parameters, is 3 scales more risky than people in her age group and is much higher than her moderately aggressive description of herself. In terms of cost, Mary's largest holding is the Vanguard Institutional Index Plus S&P 500 fund, and this one charges just 2 basis points or 0.02% annually. That's a very low expense ratio, and it's outstanding that she has placed most of her assets in a low-cost fund like this. Plus, I'm glad to see that she's doing this not just with this particular fund, but in other areas of her portfolio. She is purposely and deliberately minimizing the expenses of her investment portfolio. Next up is tax efficiency. Mary's 401k plan, like all tax-deferred retirement plans, including traditional IRAs and Roth IRAs, is growing, the money in it is growing tax-deferred. And in this case, she doesn't suffer from any major tax problems that I can see. She has no outstanding loans in her 401k plan, which doesn't subject her to any potential tax liabilities, so she does okay in terms of tax efficiency. Finally, performance. And this is really the bottom line. If your portfolio doesn't do well in terms of risk, if it doesn't do well in terms of diversification or cost or tax efficiency, usually you're not going to do well when it comes to performance. So Mary's portfolio Her one-year performance from March of 2013 to March of 2014 gained 17%, while a portfolio of passive index ETFs with Mary's approximate same asset allocation gained 18%. So in this case, she marginally underperformed by 1%, but nevertheless, she closely matched the performance of a passive benchmark of low-cost index ETFs. That's outstanding. That's exactly what you want to do when it comes to the performance of your portfolio. You want to match or exceed what passive index fund or index ETF types of investments do. So, my final portfolio report card for Mary is B+. Great job, Mary. That's a fantastic score. And it's not perfect, it's not an A, but it's awfully close. And she did well in terms of minimizing her investment cost. The total blended cost of her funds, by the way, in her 401k plan is just 20 basis points or 0.20% annually. That's outstanding. And her performance just about matched the passive benchmark that I used, and that's outstanding. So keep up the good work, Mary, and hopefully when you take another portfolio report card in the future, you'll be able to get an A. Well, that does it for another episode of Marketplace Minute. I'm Ron DeLegge with ETFguide. If you'd like to get your own personalized portfolio report card, get in touch with me. @ETFguide is my Twitter handle. You can also go to portfolioreportcard.com and reach out to me. Thanks for watching. We'll catch up with you soon.